This conference will now be recorded.
Derek, did you want to say anything before we start?
Sure. Thank you, Bob. Good morning, everybody. Hope you're all doing well. Let me introduce you all to my law partner, Chris Carolan, who is a partner in our debt finance practice out of New York. Chris is one of the key members of our firm's COVID SWAT team and has been advising our firm clients around the country and the world really on the Paycheck Protection Loans, the SBA disaster loan, and then the other relief components of the CARES Act. I'm pleased to introduce Chris to you and to let him talk briefly about the CARES Act, how it might be of benefit to your station, and to take any questions that you all have. We also have our partner, Keith Durkin, who is one of our tax partners, who is on the call and available to answer any questions you might have about the state and local tax implications if those issues come up. And with that, I'll turn it over to Chris.
Great. Thank you, Derek. And thanks, everybody, for joining us today. And thanks for the opportunity to talk to you guys. So obviously, we wish it was under different circumstances, but we're hoping to sort of keep the summary at the top of this hour to a minimum and really get it into detail with a lot of questions and conversation back and forth. So I'm going to try and go through this stuff really quickly. Each of the individual items about the Payroll Protection Act loan and the disaster loans themselves take an hour. So apologies if we're glossing anything over, but we're going to be available offline also to answer any follow-up questions that we don't get to today. And I hope everyone can hear me okay. I know there's a lot of feedback. I don't know if it's possible to put people on mute or not, but the payroll protection loans are established by the CARES Act, which was only just passed into law on March 27th, so within the last few days. It's part of the government's massive $2 trillion stimulus program, and the payroll protection loans are just one aspect of that. As Derek rightly mentioned, there's a lot of tax credits and other benefits in the CARES Act, which you may be interested in. And again, we, not the focus of this call, but we'd be happy to follow up with you, including with our partner, Keith. The main goal of the payroll protection loans is sort of obvious in its name. It's there to allow employers to retain employees and continue getting salary and wages paid to their employees. The beneficiaries of the program is really focused on eligible small businesses, which is not as commonsensical as it sounds. The term small business is actually a defined term in the SBA code, and we've been spending a lot of time in the last 2 or 3 weeks counseling our clients and both on the lender and borrower side about different issues that may make a company eligible or ineligible based on their size. One key example of that, you can be the general rule is to be under 500 employees, but the SBA will take into account the employees, your affiliates as well. And these, again, are very detailed calculations, and there's different exceptions to that. So you can have more than 500 employees if you have an industry code, a NAICS code, as it's called, that allows you to have more than that. And some other exceptions to that apply, which I think we might get into in the discussion. So I don't want to take up too much time in a verbal dump here. But the size of the loan is based on a formula that's equal to 2.5 times your monthly average payroll costs over the last 12 months, over a 12-month period, maxing out at $10 million. And payroll costs is more than just the actual net payroll paid to the employee. It's comprised of salaries, wages, commissions, and other compensation, vacation, parental, family, medical, sick leave, retirement benefits, and employee benefits of that nature, state and local taxes, but importantly not your federal or FICA taxes, and certain types of compensation to independent contractors and the like. You should remember, and I think I understand this is important to this population, independent contractors are not part of your employee calculation. The SBA determined only recently that independent contractors could apply on their own, so they're not part of the employees who can pay under the Paycheck program. The key, the cherry on the sundae of the payroll protection loan is that it's forgivable if the proceeds of the loan are used within an 8-week period for payroll costs and certain other eligible costs, which again is a very defined term under the program, which we'll get into. With the second requirement that came up recently, that 75% of the loan has to be used for payroll. If you comply with the forgiveness requirements, your loan will be forgiven and converted into a grant. It's important to know that the application started on Thursday and Friday of last week. They've been coming in fast and furious. I'm sure many of you have applied. And there's, the banks and the SBA are fairly hard and pretty busy. Funds in the program are running out, and there was news yesterday that Congress is being asked to fill up the fund again with another $250 billion. There's also another loan program established by the SBA under their General Disaster Loan Program. This disaster loan is specific to COVID. It provides loans of up to $2 million. There are similar eligibility rules, similar but not identical. The applicant has to demonstrate some harm to their business from the COVID crisis. One of the key distinctions, three of the key distinctions over a PPP loan are that the PPP loan requires no collateral and no guarantee. An SBA disaster loan may require collateral, the loan amount of $25,000, and may require a guarantee if it's over $200,000. And of course, the disaster loan itself is not forgivable. Many employers have gone out and gotten SBA disaster loans before the PPP loan came into effect. The common interplay there is the CARES Act allows the SBA disaster loans to be refinanced, that is paid off by a payroll protection loan. And many people are doing that because they'll find the terms of the PPP loans are more flexible, and of course, forgiveness is a big goal. That all being said, employers should consider the full, spectrum in which you're operating to determine if either of these loans are best for you. Just because the loan programs are available doesn't always mean they're what you're going to avail of. And it's work with your other advisors to, make sure that this is a good fit for you. I don't want to take up too much more time at the top of the call. Maybe I'll turn it over now. There?
Bob, Joe Brennen at the Georgia Bankers Association. I'm having a hard time hearing.
Joe, before you start,
just
can I just do admin thing, please? First off,
sure.
Please mute your phone so that we get interference. If you have a question, please send it to the GAB office to gchapman@gab.org, and we will take those questions and try to get them to everybody at the end of the call. And as Chris has already said, if there's a question we get to, be happy to answer it afterwards. But please, if you have a question, please email it to us at gchapman, CHAPMAN@gab.org. Thank you very much. And now we'll turn it back to Joe, who is the president of the Georgia Bankers Association.
Bob, thank you very much for allowing us to be on the call today. We've had a partnership with Georgia Association broadcasters for many years and many of your local stations we've been working with over the years to help them understand programs like this. Let me just mention, I won't be long here on the overview, but the program didn't exist Friday 2 weeks ago. It's an enormous program, $349 billion. Most of that is going to be funneled through the traditional banks. Let me focus here in Georgia. In Georgia, we have more banks, more community banks in our state than any other state in the Southeast. So we're fortunate in that perspective. The issue with us has been, with the banks has been SBA, the Small Business Administration. Most of our banks have not been dealing with the SBA before. It's a very unique kind of program. It's a tiny agency, and we have not been dealing with them. So Congress, when they chose the SBA to roll this out, it was a logical thing to do. It's just taking a bit of a while for us to figure out how to work with them, and it's been a bit of a challenge for SBA on explaining to the banks how the loans can be funneled through. Just an example, last year, the entire year, the SBA generated $30 billion of loans in the whole country. This program is generating $30 billion of loans a day. So that's flowing through the system. We were honored to be asked to help distribute this money to our customers. It's just been a challenge getting into, and it's been a challenge for SBA and the Treasury Department to issue the rules and regulations. Those came out just yesterday that gave the final clarifications that we needed to have so that we can begin actually closing the loans. So we'll begin to seeing that money flowing very, very quickly. One of the provisions in working with the SBA is that once a loan is in their system and authorized, it has to be closed within 10 days. So some of those loans were entered Friday a week ago. So if those loans haven't already been closed this week, they will be closed Monday or Tuesday of next week. So that's good news. That'll be a rolling closure. We're still getting applications every single day. They're being entered into the system, and they'll be closed. But the enormity is unbelievable. For example, I was talking to a banker yesterday in Middle Georgia. He said he is very typical of other bankers. He said we had more volume loan requests last week than we have ever had in an entire year, and that is replicated throughout the state. So I liken it to trying to take all the water that's flowing over Niagara Falls and funnel it through a drinking straw and have a week to engineer it. That's the size of the task. But we're working very hard. A lot of things broke just yesterday. And Bob, let me just leave it at that, and we can get into specific questions on process if that's helpful.
Joe, it's Chris Carolan. Are you still there?
I am here, but I don't know that anybody else is. Yeah.
Bob unfortunately just got muted. Give me 1 second, okay?
Okay.
Can you hear me?
I can hear you, Bob. This is Joe.
Yeah, I hear you too. We seem to have an echo in effect, though.
Yeah, it's a pretty bad echo in the background.
Hey, you come on here.
I wonder if some people might be logged in on their computer and on their phone. That might be causing some echoing.
Yeah, I think somehow my computer phone broke down here, so I'm on a cell phone right now. But Joe, the question I was asking was the information that you got from Secretary Mnuchin about the volume of calls and just how much money has been processed already.
Right. That's moving daily. We're the last we heard was last night. There about half of the money has been reserved, and with the president and the Treasury Secretary and members of Congress saying we'll likely see another appropriation very shortly. Congress will obviously have to take a vote on that, but we're going to ask between 200 and 250 billion more dollars. So at this point, we're waiting for that to happen. There's still capacity in the program, and so we're still seeing borrowers submit applications.
Joe, it's Chris. I have a question actually that we've been talking about with our clients. We know that the SBA said that loan applications will be processed in a first come, first served basis. And that's why we've been rushing clients who have decided to apply for it to apply really quickly. Many did so on Friday when the bank windows opened for applications. Can you give any more detail on what first come, first served means? Because, you've got, I don't know how many hundreds of SBA lenders throwing applications into the SBA at the same time. So apart from telling potential borrowers and those who have already applied, apply quickly and as soon as you can, what can we do to sort of make sure our borrowers are as far along in the queue as we can get them?
That's a great question, Chris. And this is our understanding. And again, let me disclose. I mean, as a fair disclosure here, this program is being stood up as we speak. So the program has changed every single day. The questions change every day, and the answers change every day. But my understanding, Chris, as of today, this is the answer to your question. When a lender enters the loan into the SBA system, they get a loan number and an authorization code that reserves the money in the system. So if the bank does not have authorization yet, and we still have a few in Georgia that are still trying to get in the system. We had a lot last week that couldn't get in. So it's dependent on the institution and whether or not they can get loans into the system. So once the loan gets into the system, they get that authorization code, and that reserves the money. So first come, first serve is when the application goes in by the lender and gets that loan number and authorization number.
Okay, that so truly is first come, first serve. That's really good color.
The challenge, the challenge there, Chris. First come, first serve. I mean, we have a lot of borrowers that have submitted applications and they haven't been entered into the system yet. Again, some of it is volume. I had a very small bank that has over 800 applications, and they've gotten 600 into the system. It's just a manual process that they have to use. It's not auto. You can't just upload it. It's a pretty manual process.
And that reminds me as well, it's important for folks to know that your choice of lender could be very important. The SBA's obviously working through established SBA affiliate, SBA approved lenders who are part of the program going into this, but they've also opened the door to allow other lenders to join the program. We have found two things that we've been telling our clients at least. One, if you're working with a bank already, particularly if that bank is your lender, but it could also be in a bank where you're holding your accounts, is an SBA lender, it's probably best to go through that lender because it knows you. It already has your KYC, your know your customer, and other new customer information that you probably painfully went through already with them. And I think the third and probably most important part of that, although don't downplay the KYC, but the most important part of that is they already know the SBA and the systems and how the forms, and they have a team that's experienced and overwhelmed, as Joe just said, but they at least understand what they're doing. New lenders who are joining the SBA to participate in this program may be slower to process. So I think, is that fair to say?
Well, actually, once you get on the system, it's not complicated. It's basically uploading the information that's in the application. It's taken according to the skill of the banker, it's taken between 10 and 20 minutes to upload an individual application. So we've got it's all hands on deck right now doing that. So that. Even if you weren't an SBA lender before, the SBA has done, in our opinion, a good job on creating a new portal. They worked with AWS to create that. It was released yesterday or day before yesterday. So a lot of our new lenders are accessing that portal, and it's streamlining that effort.
One of the questions that we've been getting, first off, I've gotten at least 3 members that say they got their approval. One of them is recently, in about 20 minutes before the call. But so there are some success stories. But one of the questions that we've gotten are, is there enough information for a trend for why things are getting rejected or declined?
Chris, you might be able to answer that best. One of the things we are seeing more often than not on the application, there's a one of the questions, I believe it's question number 3 on the application. A lot of people are checking yes, and that what that question is do you have ownership in any other of these entities through an LLC, or it's a question about related parties. And a lot of people are checking yes on that. and that is kicking them out of the system as a rejected loan. All that is intended to do, there's some, and Chris, please explain this to everybody, but there's some affiliated business rules that you just have to get past, but the borrower has to get past those rules in order to certify they're qualified. That is, I would be willing to bet, Bob, that might be what's kicking them out. I'm hearing that more frequently than not, because the borrowers are checking that block because it makes sense to check that block because you do have it. But all it is meant to be is to be a question that the borrower has to resolve in their mind based on the affiliated rules that everybody has to work with if they are qualified. Chris, is that what you're hearing too in your practice?
Yeah, I would approach it. I agree with you, but I would approach it in a slightly different way. The application is, of course, submitted to their SBA lender, and it's subject to a lot of scary things that if any of the information on the application is untrue, could result fines and other things like that. Not to scare people, you just have to fill out the application very carefully and very truthfully. And a lot of our clients have had issues trying to understand, first of all, how to answer the affiliation rule question. And I can give a little bit of color, as I promised before, on what that is. There's a few different ways to be eligible for the SBA loan and qualify as a small business as understood in the SBA program. If you have 500 or fewer employees, that's a good sign that you're going to be eligible. But the SBA long-standing affiliation rules apply and limit that. So in essence, your individual company is aggregated with anybody who constitutes one of your affiliates. And if that results in the affiliated entities being more than 500, you could be ineligible. This is a problem for businesses that are owned by, equity investors or larger conglomerates or things of that nature. But if you don't qualify on the 500 test, you might qualify for what's called an alternative size standard for your industry. And I don't think too relevant for this call. If you have multiple locations and no single location is more than 500 employees, you might qualify. That's largely geared at the restaurant or hospitality industry. In other words, businesses that have a NAICS code that starts with 72, and that's a code that's assigned through the SBA process. In recent days, another test seems to have come up, and this is an example of how fluid the situation is. The SBA has been releasing a frequently asked questions document, and the FAQs are meant to update and inform and flesh out the interim rules they issued at the end of last week. And if you rely on these frequently asked questions, you're supposed to be okay to apply without worrying about breaching anything. So they introduced the concept of a net worth test, where if you're a business with a net worth of less than 15 million and net revenues of less than 5 million in the last 2 years, you may still be able to apply even if you've run afoul of the affiliation test. I say may because this came up came up new this week, and we're still trying to understand. They say on the one hand the affiliation rules do apply, but on the other hand, the net revenue, net worth test also is available to you. These two concepts are a little bit in tension with each other, and shows how quick the SBA and the Department of Treasury, in partnership with their bank partners, are trying really hard to get this program on legs and running. And there's going to be a lot of these things that are, at odds with each other and will need to be further fleshed out. However, to put minds at ease, the SBA is saying in these frequently asked question documents, if you rely, in other words, in these FAQs, you're submitting in good faith, and that's okay. So what we've been saying, and that got to be a bit of a long-winded technical answer, but what we've been saying to clients with affiliation problems is your first thing is be truthful and disclose, obviously, as much as you need to answer a question fully. And that often means attaching an appendix where you may, explain and list out your affiliates and maybe even put an explanation for why you think you're on the good side of the affiliation rule. It's important to know, what we know of as an affiliate is not exactly the same as what the SBA regards as an affiliate. So even a minority holder that has some basic veto rights or minority control decisions or things like that sometimes get negotiated, because of that control, could be deemed to be an affiliate. So there's ways around that, of course. That minority can agree to give up those control rights, but then you're into a negotiation with your minority holder.
We had a real life situation like that just this morning where we were talking to somebody and one of the investors did not give his information, and that was calling up the deal, but finally they made an arrangement. So this is a real world thing, even for small amounts where one of your big investors does not cooperate, then you've got to make sure, because I think you have to have at least 80% recommendation. Does that sound right, Chris?
Unfortunately, I think I only heard every other word, but I think you're on the right track. Yeah.
Okay. One of the questions that we got, you started off talking about the payroll and the benefits, but the question has come in: what if you could just go into a little bit more depth as to what makes up the terms of the loan? In other words, how much they can, let's use $100 or $1. How much of that? 75 cents of that has to be the payroll. But what are the other elements that can go into making up the request for the loan?
Yeah, I did gloss over that when we were rushing to get started. So the other eligible costs are generally things like group health care benefits, paid medical family leave, insurance premiums. You're allowed to pay interest on your mortgage. You're allowed to pay interest on other debt if that other debt was incurred before February 15. The mortgage debt appears to be eligible for forgiveness. The interest on other debt, so unsecured lines of credit or loans secured by personal property, that may not be forgivable, but you're seemingly allowed to use the loan to pay that interest. You're also allowed to use it on rent payments. The key dynamic here is to review the full list of eligible costs and know that this is a program that's geared first and foremost to keep people employed and get them paychecks. So if you spend less than 75% of the loan on payroll costs, and I can go through the elements of that again if helpful, the portion of the loan that is less than 75% may no longer be forgivable. It's important to note here too, and the SBA has promised us more guidance on how forgiveness will work, and I think they'll get into some of these details on that. So right now we're only kind of dancing at a high level on how this is going to work because we're still waiting that further detail from them.
And Bob, Chris, let me jump in here too, because this is one of the more confusing things for borrowers, because the loan amount is determined based on payroll. The forgiveness amount is based on payroll and all the other things that Chris just talked about. So the loan amount, 2.5 times average monthly payroll, that includes the salaries and all the benefits and all that comes into the actual loan amount, and it's 2.5 times that average monthly deal. Then you add in, then when you go back 8 weeks later to your bank and say, this is how I spent that money, and if 75% of the money that was spent on payroll, and 25% was spent on the eligible costs that Chris just mentioned of rent and utilities and mortgage interest and that sort of thing, then the loan's forgivable. So it's confusing to a lot of people, but payroll and benefits determine the loan amount. Payroll plus authorized expenses determine the forgiveness amount. And the bankers are folks trying to help folks understand that, because there's a lot of confusion about where's this money coming. This $349 billion is not coming from the government to the banks right now. The banks are lending their own money, the money they have on deposit right now. That's the money that's being lent here. And so when the forgiveness portion comes in, the bank will work with the borrower and say, okay, I certify that you have certified to me that that's the amount you spent. I agree with that. And then the bank sends a bill basically to SBA and they get reimbursed. That part is forgiven off your loan, but the bank won't get any money back under this program until we're probably looking at 9-10 weeks out. So it is confusing about how the loans are determined and the forgiveness is determined. But as we know more, we will certainly communicate that. Chris, with that, that's kind of what you're telling people.
Yeah. Go ahead. Sorry.
Yeah, I think that was good. I'd also demystify the forgiveness a little bit, just to say forgiveness we think is probably most people's goal. You want to turn this into a grant instead of a loan. But some companies may look at it and say, this is still pretty cheap financing, and as long as I'm using the loan for approved purposes under the program, I'm willing to pay my interest and repay the loan over a period of time. Which, by the way, if you wind up having to repay this loan, it's a 2-year period to repay it, and your interest and your principal is deferred for the first 6 months. After that,
the other key thing to really remember on that, the forgiveness clock starts on the day of disbursement, and we are required to disperse the loans, first disbursement, 10 days after it's approved by SBA. So the forgiveness clock runs that 8-week period, beginning that day for 8 weeks. So just sort of keep that in mind. A lot of our small business borrowers didn't understand that, and they're with the shelter-in-place orders and that sort of thing. A lot of people don't have employees able to come to work, but that's they're going to have to be paid or somehow not get that part of the loan forgiven. That's part of the structure of the program. It's not our rules, the program rules, but it's something that is being questioned by a lot of small businesses.
And another question that people are afraid of is if they have a loan, if they met 80% of the goal, they're only going to have a 20% loan. Is that correct?
I'm sorry, I didn't quite follow the question.
Yeah, at the end of the 8 weeks, if their 75% of payroll adds up to 80% of the loan, then they would be forgiven 80% of the loan and owe to pay back the 20%. Is that correct?
No, that's not my understanding necessarily, because they still have those other rent, utilities, mortgage interest. That comes into play, but only the number is 75-25. 75% of the forgiveness has to come from payroll. The other 25% from the other costs.
Yeah, Joe.
If anything's left over, that converts into a loan. Is that right, Chris? That's your understanding?
Yeah, that's absolutely right. Think of it as 3 buckets. The loan can be used for 3 things. 1 is payroll. 2 is other approved eligible costs that we went through before. And the third thing I would say is probably other lawful working capital purposes. If you do anything under that third prong, and I'm going out on a bit of a limb here because we do not have those forgiveness rules, so please consult with your own advisors and your own lender as you think about how to parse this out. But that piece would not be forgiven clearly. But as long as you remain in the 75-25 ratio that Joe just went through, so 75% goes to payroll costs and 25% go to the delineated, approved SBA list of things that are eligible for forgiveness, you're going to be okay. But Bob, I don't know if you got any specific question on maintaining headcount and salary, but we should go into that detail as well, because you have very clear maintenance covenants about number of employees and the amount of salary that you have to maintain over the 8-week period to achieve forgiveness.
Why don't you go through that? I think I shouldn't have used 80% in the question. But yes, if you could kind of explain how that works, it may answer the other question that I was trying to ask.
Okay, great. Yeah. Again, I feel sort of sheepish about this because these things are so technical, but they are what they are. I guess what I'm saying is it's not my fault they're technical. So remember, the whole point of the program is to maintain employment, to minimize unemployment in the country during the COVID crisis. And the program assumes an 8-week period is going to be the critical period for measurement. And as Joe pointed out, it's 8 weeks from the day you get your loan. we talked about how you use your proceeds, but you also have to maintain your employee headcount and certain salaries. So.
Oh, okay. So he's a happy camper. Okay, thanks for your help. Bye-bye.
Please mute your phone.
So on the maintenance employee prong, it's two prongs: employee headcount and salary. The amount of your loan that's forgivable will be reduced if your average number of employees during the 8-week period is less than your average full-time employees in the period between February, June of 2019, or between January and February 2020. And the or is your choice, as we understand it, in your application. So I'll just go through that again. The program requires that your employee headcount during the 8-week covered period match your average employee headcount in a period in 2019 or January, February of 2020, depending on what you chose in your application or what might be applicable to you. You also will have your forgiveness amount reduced if salary or other wage reductions are 25% or more of the employee's salary or wages during the most recent full quarter of employment before the covered period. So for most of you, if you applied in April, that's going to be first quarter 2020. If you, as the most recent full quarter, I assume too that this is calendar quarter as opposed to your own business fiscal quarter, but I'm not sure about that. We'd have to look into that one.
We have another question, and it was semi-answered, but I'm hoping we can get a Cliff Notes version of this. I think one of the most important things for anybody applying for the loan is to be prepared. Would it be possible? I know there was 18 questions, or 6 pages long. Is there a possibility that we could get a 1-page checklist to kind of give the people the X's and O's? I don't know if that's a Joe question or a Chris question, but how can they be best prepared to walk in, and some simple steps, if you could, for the purpose of this call?
Well, Bob, it's pretty darn simple. Chris, go ahead and answer that. But coming in initially, all you've got to focus on is payroll. And if you've got documentation from maybe a payroll company or an accountant, whoever does your payroll, if you've got that documentation, that's all you need right now. The other documentation we've been talking about is related to the forgiveness period. The one thing I do caution you, and Chris raised this earlier about why we encourage people to use your existing bank is because you don't have to provide all that other documentation that's required under Know Your Customer rules, under all the cyber stuff that we have to get. That is a lot of information, a lot of documentation. So, Chris, I don't know how else to describe it, but if you've got the payroll records from either your own system or an accounting system, that's all you need to be worried mostly about right now. Is that right, Chris? Is that what you're telling folks?
Well, we're also telling folks, yes, Joe, but we're also telling folks to look at the actual SBA, most recent application, because that will include the list of the deliverables that you have to initially give to your bank along with the application. So it includes a lot of information that a bank that is already that you're already a customer with that bank would already possess.
And that's pretty well defined on the application form. But again, if you're dealing with your current bank, they have pretty much everything except the payroll information that you need to provide.
This is a very specific question, but one of our questions we just got was that one of the big banks that had trouble before, are they still having problems processing loans? And I guess I have to say Wells Fargo was having problems early in the week, but they've solved those problems now, haven't they?
I won't speak on behalf of Wells Fargo, but there's been a temporary order issued by their regulator to allow them to participate in the program. and they had hundreds of thousands of applications that are now being processed, is my understanding.
So the call said that they tried to go through Wells Fargo and it didn't work, but that they also had acknowledged it was over the weekend. So that has been resolved.
This happened yesterday.
So this is public information. Wells Fargo is in a unique situation where because of some regulatory issues it had past, which people can read about, they had a certain cap that didn't apply to other banks necessarily on how many payroll protection loans and other SBA funding they could participate in. And what Joe just said is that cap has been temporarily removed so that Wells can participate in this program. So hopefully that means Wells customers are not at a disadvantage anymore. Wells did hit a cap on Friday.
And just as general information, also this is public information there were about 30 banks in Georgia that were active SBA lenders, and year in, year out, Wells in Georgia has been sort of the largest bank in our state with those specific SBA programs. That doesn't have anything to do with this program. So a lot of people were, customers of that bank, and now they don't have to find another bank.
We received a question specifically on the third line of the app, and saying that the third section was confusing. I don't know if you have the app in front of you, or if you've had constant or some other complaints about that, but it's a very specific question about the third line being confusing.
I don't know that I have it in front of me. Chris, do you have it?
I thought it might be a little too specific, but.
Well, question 3 is the affiliation rule, where you're
oh yeah.
Yeah. So yeah, that is
right.
that is one of the most common pain points that our clients have anyway when completing these applications. Some people have a lot of trouble trying to figure out the employment headcount and payroll and things like that. But I think question 3, where the list of affiliates, is the most problematic. And it's actually really hard to answer that on a generic basis. What we've done with our clients, we've actually had a look at their organizational chart and know who owns who and how many employees at different levels, and really go through a very particular process. But I think if you just remember the goals of what that question is asking, they want to make sure that if they give a loan to a business, that it is a qualifying small business that does not exceed whatever the right number of employees it can have under the SBA rules to be a small business. I know that sounds circular.
Chris, we're running into it with very small businesses. They just happen to have an LLC. They may have a building that they own, that they operate out of. They have it in the LLC. They may have another business interest. But these are not conglomerates. These are not huge affiliations. These are not private equity funds. These are just regular folks in a small town. And you look at that question, and you think, oh gosh, I sort of have that, so I'm going to check yes. Well, if they look at the affiliation rules, which their banker can help them with, they would check no, most likely, on that question, and that would get them through the system.
Well, and even more hopefully, I don't know that answering yes to that question it means your application is going to get denied. You're answering yes to that question to then provide the additional data to confirm that you're still on the good side of the affiliation caps. So, for example,
when I say denied, this is on the banker side. When they are entering in the new portal, Chris, when they're entering this information in the portal, if they check yes in that portal, they get a message that the loan is denied. So they have to start all over entering the system. It's an ineligible borrower. So, that's got to get dealt with. We've told SBA that's a problem. It's something that really needs to be fixed. But that, when I say it's denied, the system is kicking out that application.
We had a question about if the employee is let go during this process, but the person is replaced. The loan doesn't care if it's Jim or Joe working. It cares the payroll number. Is that correct?
That's correct.
Okay.
Yeah.
So it's not
the terms they use are average full-time employees. average numbers.
Does it matter if the one person was an announcer and now he's a salesperson, as long as they just had the number and the compensation? It doesn't matter what role they're in.
Well, for the payroll loan, it does not matter. We don't see anything yet in guidance that says it would matter, so we don't think it matters. It's important to know that all other employment law applies to these scenarios. So your state and local and any federal additional employment, wage hour, and other types of laws will, and also your contracts, if anybody's under contract, will impact your decisions on how to deploy people.
We've taken a lot of everybody's time, and we're past where we'd like to be. But one of the things I'd like to do is kind of summarizing. The question has come up. Can you repeat the terms of the loan? Just kind of take people through, and let's just concentrate on the PPP. Just to review the terms one more time for the people that might not have been on the call when we talked about that.
Sure. So the PPP is the Payroll Protection Program. They're loans to eligible small businesses that are used for payroll and other eligible costs. The loan amount is calculated as 2.5 times an employer's monthly average payroll costs over the last 12 months, but the loan will cap at $10 million. So in other words, if your 2.5 times payroll costs led you to a $12 million loan, you'd only get $10 million. The loans can be used, as we said, for payroll costs and other eligible costs, and it's forgivable if you use the loan proceeds for those eligible costs, use 75% of the loan proceeds only for payroll costs, and maintain your average full-time employee headcount during the 8-week covered period, and do not reduce salaries and wages by more than 25% over that covered period. There's no collateral. There's no guarantees for the PPP loan. And if it's forgivable, it's essentially a grant.
If it's low, it's 1%. Is that right?
Yeah. If any portion that's not forgivable has an interest rate set at 1%, there's no other fees payable to the SBA or to your lender, and there's no interest or principal payments for 6 months after the covered period if there's anything left over that you have to pay. The maturity date will be 2 years. And Joe, is that 2 years from the origination date or 2 years after the 8-week period? I assume the origination date.
It's when the loan is closed. Origination date, yes. So think of it like this, Bob. Think of it like this. Most people are trying to make sure that what they borrow is the forgiven part. So, focus on that. If they have some left over, it converts into a regular loan. They don't have a payment for the first 6 months, but for the next 18 months, whatever that unforgiven portion of that loan, they've got to pay that piece back, and the interest rate is 1% on that.
And my confusing question, you just perfectly summarized what I was trying to get at before. They have 1% loan, 6 month forgiveness period, and it's just on the balance of what was not forgiven.
Right.
Chris gave a great summary. You just did too. Do either one of you have any kind of closing comments, summary? We've gone through an awful lot. I can't help but thank you so much for taking the time. I want to thank Derek for getting this started for me at Baker Hostetler. They're our law firm. They've done a great job for us, and Derek's been our lawyer for well over a decade. We couldn't do it without him, and this was just one more example of the great partnership we have. Joe, the Bankers Association has been tremendous on this, and we will be sending out a summary of this report. This conversation has been recorded. It will be available online for people to listen to again, and we will try to highlight the dozen or so highlights from the event and put that into a list. And I think Chris and maybe Joe too, but I think you offered that if there's a specific question, how should we go about getting the questions to you? We don't want to just overwhelm you in your office. Should they be coming through me, through Derek? How's the best way if they have a specific question to get some help?
To me, jbrennen@gabankers.com.
And for Baker
Yeah.
Hostetler, you can reach out directly to me, and I can connect you with Chris or Keith Durkin, our tax partner, as necessary.
Great. All right. Well, again, thank you, everybody. Appreciate the number of people on the call, and appreciate very much our partners helping us out with this. Look forward to talking to you again, and thanks for everything that you're doing. And stay safe and stay healthy. And we're going to get through this together. Thank you very much for being on the call.
Have a good day, Bob.
Thank you, Bob.